Yeah, hello, welcome back to the channel and welcome back to business taxation. This is now a fifth part of our small lecture on business taxation, and we begin with talking about some special topics. So the first one is now the corporation tax systems. Yeah. So today we are talking about the definition and the underlying problems of the underlying problem, which is economic double taxation. We are here somewhere in the fifth chapter, and let's begin at the beginning. That's with the introduction. Some decades ago, there was a very wide range of so-called corporation tax systems all over the world, and especially in Europe. That changed a bit over time, but originally we could find so-called full imputation systems. There, the corporation tax was, when the dividend was paid out, credited to the shareholder, and so credited against the shareholder's tax liability, and sometimes even partly or fully refunded if the corporation tax which had been taken was higher than the income tax which was due on the level of the shareholder. So in that case, the corporation tax was virtually only a kind of a prepayment on the later income tax of the shareholder, comparable in a certain way to the wage tax for the income tax on wages. The only difference was perhaps that the corporation tax was levied at the moment when the profit was made, and probably or sometimes the distribution of these amounts as dividend happened years later. But in principle, the mechanism was a bit similar. So in a full imputation system, the shareholder fully got back the credit, the corporation tax. And there were so-called classical systems. There, that was the term for corporation tax amounts which were definitive, so which you did not get back in form of a refund or tax credit. And last but not least, there was also a kind of a compromise between the two alternatives, so-called partial imputation systems, where a part of the corporation tax remained definitive and another part could be claimed back in form of a tax credit or the like. Well, now, naturally, how would that work? Imagine that the corporation tax had been 50%. Let's assume this tax rate, because historically, very often tax rates were very high, and 50% always has the advantage it can be easily computed. So imagine that the corporation tax had been 50% out of an original profit of 100. Then in a full imputation system, that would work in a way that you get a dividend of 50. That is the net amount which remained after corporation tax. And in addition to that, you get a certificate by the company which certifies you that a tax of 50 has already been paid on that dividend, so you also get a tax credit of 50. Now a tax credit is a monetary advantage, so this is also a revenue. So your total revenue from the dividend would be 50 in cash and 50 in form of the tax credit, so together 100. Now one would compute your individual tax rate, let's say 30%, apply it to the revenue you owe the fisc tax of 30. The tax credit, which has already been taken on the corporation tax level, was 50. Now you got a refund of 20. In the final result, in such a system, the corporation tax has been fully refunded at the moment when the dividend was paid out to the shareholder. So your financial situation would now not be different in the least compared with the financial situation of somebody who was a sole trader or a partner in a partnership. because in the end, all what matters for the tax burden is your personal individual income tax and income tax rate. In a partial imputation system, how would that have worked? Imagine again you get a dividend of 50 and then you get a bit of the underlying corporation tax as a tax credit, let's say half of it, so 25. So in that case, again, your revenue is 50 cash and 25 from the tax credit. So the total revenue from the dividend would be 75. You would have to pay income tax on the revenue of 75. Let's say if it's 30% again, then that is, oh my God, a bit less than 25. Let's say 24 or so. Credited would be 25, so perhaps you get a bit back, or you have a small amount still to pay. Oh, okay. Your total tax burden would be, if you also look to the corporation tax level, a bit higher than if you had invested your money in as a sole trader or as a partner in a partnership, because if you had earned 100 via a partnership, you would probably only have paid 30. So it has been taken an amount of 25 definitively in my example on the corporation tax level, and then another 25 on your personal income tax level at a rate of 30%. Altogether nearly 50% instead of only 30 in the case of the other legal forms, so that would be not nice. In a classical system, the corporation tax would have fully become definitive. So there you would get a dividend of 50 and no tax credit at all. You would pay 30% or whatever your rate is on the 50, let's say 15 euro. So the overall tax burden had been 50 plus 15, 65 is relatively high. So you would probably try to prefer to invest in form of a sole tradership or partnership. So here you see the total tax burden which results from an investment into a company or a sole tradership can now be totally different depending on the kind of legal form which you choose, and especially depending on the type of corporation tax system which is in your state. And so the corporation tax system has an enormous influence on the attractivity of a location as investment location. It greatly influences the net results which remains after taxation in the long run when the dividend is paid out. So what the investor really sees as net result. So naturally we should have a closer look on what a corporation tax system is and how it works. As you see from all the examples which are brought forward, the total tax burden from a corporation will be totally different from the tax burden which you have if you invest as a sole trader or partner in a partnership. So the investment net return becomes to depend on the legal form of an enterprise, and that's something which normally a law should avoid, because the legal form is rather a formality, and so your tax burden would depend on which formal way to invest you choose. Normally, a good tax is a tax which is neutral for decisions, so that whenever you make a profit of 100, you end up with the same total amount of tax, irrespective of which way you choose. In that case, there is no distortion of your behavior. If you want to achieve a profit of 100, you always pay the same tax. So the tax will not be the decisive aspect which governs your total behavior. Now, under the corporation tax aspect, that has to be feared. And now people would definitively not regard it as just and fair and good tax system if such enormous differences in the net result just result from a formality like the legal form which you choose. So, what can we do here? The problem is that corporation tax always poses a problem for the neutrality, because if you have a look to the underlying situation, if you choose the way to invest as a sole trader or as a partner in a partnership, then you only pay income tax. If you have a corporation, the corporation first pays corporation tax, and later you pay income tax on the dividend. So if you treat the dividend completely alike like all the other income, then you have a rather devastating outcome. Corporation compared with sole tradership. Corporation pays a tax, and later dividend comes and you pay again a tax. So in case of a sole tradership, you pay once a tax. Now draw the comparison. 2 taxes in case of a corporation in the course of time, 1 tax only in case of a sole tradership. Now, it's a rather trivial question. Which legal form of investment would you now prefer? We can draw a simple conclusion. If we do nothing about the total tax burden in the left case, corporation tax, then we can reasonably assume that only a full, complete idiot would invest in a corporation. Imagine 50% taken on the corporate level, 50% of the remaining amount later taken on the income tax level. If 50% is the top rate, this is devastating. Who would prefer 2 times 50% over 1 times 50%? That is impossible. So you could strongly simplify company law. You could replace the whole 400 paragraphs or so law on companies, on limited companies, by a simplified version. Paragraph 1, there is the legal form of a GmbH. Paragraph 2, nobody will ever use it. Paragraph 3, if anybody undertakes a serious attempt to establish a limited company for economic purposes, then that person gets automatically declared as unfit for business and is placed under supervision, or gets somebody who takes care of his or her business affairs, because that person is evidently mentally ill. Paragraphs 4 to 400 cancelled for reasons of non-necessity. So that should be very, very simple. And if you really want, as a legislator, that the legal form of a limited company is effectively also useful and used, then you have to draw consequences. As you see from the graphic just before, in case of a corporation, we have in the course of time always that economic double taxation of the same income. By the way, it is called economic double taxation because formally, under the strictly formal aspect here, not the same taxpayer is twice taxed. But formally, 2 different persons are taxed in the course of time, but naturally, economically, that hits the same person, because the investor naturally is indirectly hit by the corporation tax, which lowers his or her or its dividend income. So if you could alternatively also operate via sole tradership or partnership, nobody would ever be willing to use a limited company. That enables us to draw a conclusion. Probably a full classical system without any mitigation of the double taxation effect can only be afforded in countries where, due to tradition or legal constraints, nobody would ever act as a sole proprietor due to reasons of liability or tradition or what else. So offering corporations as a vehicle for economic activity can, in other circumstances, only work if the legislator mitigates the effects of that economic double taxation in the one or other way. So, and this is exactly what the term corporation tax system is all about. Any legislator must make a decision if it wants to reduce the total tax burden which results from the two taxes, and in how far they want to reduce that double taxation, completely, partially, not at all, and so on. So for that reason, we can define a corporation tax system as simply as follows. A corporation tax system is nothing else than the mechanism how corporation tax and the income tax on dividends work together. Or alternatively, you can also say a bit more abstract, it's a mechanism which coordinates the corporation tax and income tax on dividends, naturally. So that's a corporation tax system. And now, as it is all about the decision if and in how far the double taxation effect from the two taxes is reduced or not, you can even distinguish categories of corporation tax system according to that criterion. You can have systems with a full removal of the economic double taxation, so like a full imputation tax system. That was the system where you got a tax credit in full extent for the corporation tax which had been already paid, or systems with a partial removal of the economic double taxation, for example, where the law says, well, of the corporation tax I keep half and the other half you get credited, so that a bit of the corporation tax is given back to you later. And there might even be systems with no removal of the economic double taxation at all, so an unmitigated classical system. If we go more into details, you can also make, and that's far more attractive, a classification, or you can systematize the systems according to the way by which technique the economic double taxation is reduced. Because if you want to reduce the double taxation, you need to reduce in the one or other way the burden on one of the two levels, which are their corporation tax level or income tax level. So you can reduce the burden of the corporation tax level, or you can decide to reduce the income tax level. And now on the corporation tax level, you have, again, alternatives. You can reduce the tax base. For example, you could say, well, those amounts which are paid out as dividends, we leave them tax-free. Or only half of the profit is taxed under corporation tax. Or only half of a dividend or half of a dividend can be deducted as a business expense, or whatever you like. You can make mitigating effects when you compute the tax base. Or you can say, we reduce the tax rate. For example, you could say, well, in our country, the full income tax rate is, let's say, 50%. So I say my corporation tax rate is only 25 or 30% or only 10%. So in that case, you reduce that economic double taxation effect automatically. You could also take refuge to such an imputation system and say, well, we collect the full tax on the corporate level. Let's say 50%, rather brutal. But when that corporation pays out that dividends to the shareholder, the corporation tax is given back in form of a tax credit. So then in the end, it is automatically replaced by the income tax. And in the end, only the income tax of the investor counts. Might be an idea. So you have at least these three different categories, these three ways how you can play around with the tax burden on the corporate level and decide where you reduce in how far. You could even combine these things. On the income tax level, you have, in theory, again, the same possibilities. You can say we will reduce the tax base in case of a dividend. For example, you know the German system. In many cases, 40% of a dividend are tax-free. That's an example for reducing the income tax level burden by influencing the tax base. You get a tax exemption of 40% of the dividend, only pay for 60%. You could also say we reduce the tax rate for the dividends. Alternatively, that's the question, or that's the case if your dividend is received as income from capital in Germany, then we have a flat rate of 25%. Although for rich people otherwise, we have 45% income tax rate. So here you have a reduced tax rate instead. By the way, in the German system, you never get the combination of both. You either get the 60-40 rule, so that 40% are tax-free, or if your dividend is classified as income from capital and you do not opt for the regular taxation, then you get 25% rate, but then on 100% of the dividend. You could also think about a refund system. In theory, you could also say the corporation tax remains definitive and the income tax paid by the shareholder is refunded to the company which paid the dividend. This is rather a theoretical possibility. I 30 years ago read somewhere that some expert thought about such a possibility. Was so strange, was never implemented in any country I know. Although I believe there was a debate somewhere about it. But this is rather for reasons of completeness. Good. Naturally, you could combine all these variant possibilities, and that is what sometimes happens in practice. Now, you have an overview of what can be done. Historically, the imputation systems decided to use the tax credit technique on the corporate level. So they took corporation tax according to normal rules, then they completely removed the economic double taxation, and that led to a full tax neutrality because in the end only the income tax was left over. That was a huge advantage because it established tax neutrality between the corporation and the partnership as legal forms. Now, these systems had a disadvantage because if you virtually refund all the corporation tax revenue to the shareholders by a tax credit, then in a cross-border case, you have a problem. You know the double taxation treaties, or you will get to know them. If a refund has to be granted to a foreign shareholder, then it will be a case for a double taxation treaty. And now in a double taxation treaty, the usual rule on the taxation of dividends is that the dividend taxation right is split between the two states. The state of the shareholder can usually fully tax the dividend, and the state where the dividend comes from has only a limited right to tax the dividend. Let's say very frequently the highest tax rate which is allowed to apply on a dividend is 15%. So if you have a corporation tax rate of 50% and then you decide to fully grant a tax refund for the 50, then you end up with a total amount of only 15%. So in that case, you would give away most of your tax revenue, which you could obtain from the business sector, to a foreign country. It could even come worse. If you are not willing to classify the tax refund as an additional part of the dividend, if you under certain formal aspects say this is something else, then it would end up as income classified under Article 21, and then only the state of the recipient would have the right to tax it. So you would lose everything. That was the reason why historically such an imputation system was only established for inland cases. Only a shareholder in the inland usually got the right to that tax credit, because otherwise that would have become too expensive. So the full imputation only worked in the inland case, not in cross-border cases. This was naturally a problem. So you had internally inside your state no distortions between the legal forms, but in a cross-border case you had them. And the foreign shareholders had a huge economic disadvantage when it came to the possibilities of reinvestments and net returns. So that was rather distorting the markets. So that again leads to discussions if that can be done in, let's say, an EU which says the free movement of capital is to be guaranteed and foreign investors must not be discriminated. Now you could say, well, this is just a necessity, we have good reasons, but one could also say your reason is only to save money. You should set up a system which wants to generate tax money in a way that it doesn't discriminate. So discrimination is necessary because it brings money or it brings more money, is usually not a justification, though the states feared that this system would break down under criticism from jurisdictions. So many states, out of precaution, abolished such full imputation systems around the 2000s. Furthermore, the more and more the markets globalized, the less such full imputation systems could really have a positive effect. If, let's say, 80% of your shareholders are foreigners, you end up with having no imputation system at all in 80% of the cases. So having no mitigation of the economic double taxation. So the more and more the markets globalize themselves, the less and less these systems were able to function. Some states tried to enter into negotiations in the double taxation treaty negotiations with other states. They tried to improve their rules for dividend taxation and tried to agree on a cross-border credit under circumstances where they said, okay, then we share the tax burden in a more generous way, but that would have demanded a renegotiation of thousands of tax treaties worldwide. And so in the end, more and more states just decided to abolish the imputation systems where a tax credit was granted, and they turned to other solutions. So Germany, for example, decided to turn to a completely different technique, where now the corporation tax was designed as definitive. Naturally, we wanted to grant a reduction, so we decided to fix the corporation tax no longer on the top level of the income tax, but approximately of half of that level. So they chose to fix it at 25% in 2000. And then half of the dividend revenue was declared as tax-free. So that led to the following situation. If you were a sole trader, you had once and for all one full income tax when the profit was made. When you invested into a corporation, then you have first 25%. So that was half of a full income tax level, approximately. And then half of the dividend had to be taxed according to your personal income tax level. So that was a total of 2 half tax levels. And 2 times 1/2 is 1 times full. So one could say that is approximately the same. Now, a bit later, things changed. More and more, the corporation tax rates worldwide dropped down. So from 2008 onwards, the Germans wanted to have a reform with a lower corporation tax rate. And now they didn't want to change the system completely. So they just adjusted the percentages for the two levels. The idea was, if we assume that the shareholders not always are super rich, then they will probably not pay 45%, but okay, usually shareholders are not poor, so let's assume 40% is a decent assumption what they will owe to the fisc, the average shareholder. So the idea was not, now instead of 50-50, let's think about 40% of a full tax on the corporation tax level and 60% on the income tax level. That was the explanation why we ended up again with the same logic. 40% plus 60% is again one full tax. Now 40% of an estimated average tax rate of a rich investor, but not super rich investor, is 40%. So we would end up with 16%. And then they said, okay, let's round it down a bit. Let's say 50. We have that solidarity surcharge on top. So 15 is approximately 16. It's the same, but 15 sounds better. And then they said, okay, then let's exempt 40% of the dividend. So if we add it up, we have again 100% of, and indeed, if you calculate 60% taxed with 40%, that's approximately 24%. If you add it up, you end up approximately at 39 or so. It's not absolutely exact, please tolerate that. And then people came to the idea that with the 24%, that could even be simplified. Let's talk about that capital income tax, which is taken as a withholding tax on dividends. You know, when you get a wage paid out, there has to be made a prepayment to the fiscal office by your employer, the wage tax. The same applies to interest payments and dividend payments. If somebody makes a dividend payment to you, especially a company, they have to make a prepayment for the income tax or corporation tax of the recipient to the fiscal office, and that is 25%. And so they said, hey, that would be fitting. 25% prepayment as in form of capital income tax, 25% is approximately 24. And so, well, the corporation tax level, we rounded down by 1% to 15. Here we could round up a bit. And so we could say 25% prepayment in form of a withholding tax. Hey, that's pretty near the adequate tax burden. So we just say 25% is definitive for most cases. In all the cases where somebody has income from capital, we just say if the 25% prepayment has been taken, that's definitive. And in other cases, if somebody hands in a tax declaration, we grant them a tax rate of 25%. You know that already. 32D1 ESDG in Germany, special tax rate for income from capital. If you do not opt for a regular taxation, which would be probably a bad idea. So that was the idea underlying the new tax rules in Germany, which are valid nowadays. You see, that is the system behind it. We add up the two levels. Other countries naturally play differently with the different components of the corporation tax system. For example, I believe Estonia, at least in the past, and I believe they even do it today still, they had a system where distributed profits were left untaxed. So there only the income tax of the shareholder counts. That is naturally completely removing an economic double taxation by a single taxation on the income tax level. And naturally this is very generous because you give away much of your tax revenue to foreign investors. Probably only something which a low tax country can really afford. Greece, in former times, some decades ago, had a system which worked exactly the other way around. They said we take everything on the corporation tax level and then leave dividends tax-free. Rather a great idea, especially it could simplify things. If you say, okay, a company cannot escape our fiscal authorities, we can tax it in full. And then when the dividend goes to the shareholders, we can reasonably expect that the shareholders will not pay, and we do not have to bother about their honesty because we have already taken corporation tax at the top level of income tax. So everything is taxed at a high enough level, so that gives a good feeling to the shareholders. They don't see that they have been plundered already on a different level, and so they are happy because they have the idea that dividends are tax-free. The state has a full revenue and everything is happy. So as you see, these two systems are in principle not completely different. They just combine the weight factors, which Germany has set as 40-60, with different percentages. 0, 100, or 100% and 0. So these two systems were rather extreme versions of the same system which happens to exist in Germany at the moment. By the way, the different types of tax systems often simply reflect the technique and extent by which a reduction is granted. The imputation system is a denomination for systems which remove or mitigate the double taxation, the economic double taxation, by a tax credit. The full imputation system gives a full tax credit for the complete corporation tax and the partial only in part. If you mitigate the double taxation effect by giving a relief, a reduction on the income tax level for dividends, this is often called a shareholder relief system, because you know, relief, reduction. So the present system in Germany might be characterized as a shareholder relief system because there is a reduced income tax rate for dividends, or there is a tax exemption for 40% of the dividends. By the way, just to remember that the two effects, the two versions never occur together. So if it's 25% tax rate, then on 100% of the dividend. Okay. And there is even the denomination classical system, that is in general, in the broader sense, only a denomination which signalizes there is no tax credit granted. So a shareholder relief system, as characterized just now, would be a classical system in the broader sense of the definition, in the wider sense. You could naturally also use the word classical system for labeling a system where there is no mitigation of the economic double taxation at all. In that case, I would like to introduce a further term. Let's call it an unmitigated classical system. That would be one where you have no reduction at all granted. So regular tax rate for dividends and regular corporation tax rate. There may be still countries where the legislator decided to grant no reduction of economic double taxation or nearly none, so where the people decided to live with the distorting effects. If that is the case, you will always see that the taxpayers and the corporations begin to adapt their behavior accordingly. You will have adequate reactions to that distorting effect of the legal system. For example, historically, Germany, 100 years ago or so, so far before my time, Germany had a completely unmitigated classical system. So I don't know which tax rates they had at the time. Now imagine they had 50% income tax on dividends and 50% corporation tax. Then, and the income tax for sole trader would also have been 50%. Only in such a system, if you are German, you naturally dislike the tax, but you want to remain honest, so you create the ingenious idea of founding a so-called GmbH and Co. KG. The underlying logic and the way how it worked was as follows. First, a natural person, you, wants to invest money. Now, you want to pay income tax and not taxes twice. So you want to become a partner in a partnership, but only a limited partner. So you need a KG. So you decide there must be a KG. Now, in a KG, you need limited partners, but you also need at least one full partner. So you need a full partner. Where can you get such a full partner? No natural person whom you know ever wants to do this job because of the unlimited liability for the obligations, debts, and so on of the enterprise. That spoils the fun, so nobody wants to do it. You need somebody who doesn't feel or doesn't fear the risk. And well, you take a GmbH for that purpose. Because a GmbH doesn't fear anything, it has no brain and nothing to lose. So you found a GmbH and take the GmbH as a full partner. That's a bit surprising, but a GmbH is a person like all the other persons. It has all the rights of any person. And as persons can found enterprises and can form partnerships, this person now makes a partnership with you. GmbH says, I am going to be the full partner, you are the limited partner. Happiness everywhere. Now that GmbH as a full partner can do all the management. They have a legal right to that. You can't exclude the full partner from the management. So you need a GmbH full partner whom you can trust. Now, under which circumstances can you trust a GmbH? Well, the answer is if you own 100% of the GmbH's shares, or at least the majority of the shares. So this GmbH is founded by you, by the limited partner. So now you have a GmbH, which is owned completely by you. So in the end, you form a partnership with your own company. Why not? You are legally two different persons. Now we come to the remaining question of the profit distribution. And now the attractive trait in a partnership is that you are completely free to agree on which share in the profit goes to which partner. That just can be freely decided in the partnership contract. So if you really prefer drastic and clear solutions, the partnership contract says 100% of the profit go to the limited partner, to you, and 0% to the GmbH. Or you could say, well, the GmbH risks its neck for taking all the liability, so it should get a bit. Then you claim 99.9% for yourself, and the bit goes to the GmbH. You are free to decide about that. You can also decide in the partnership contract who has to do which work, and so you can even present that distribution of the profits as adequate. So that was a great idea, because now the natural person got his or her share directly under income tax law, no economic double taxation, and nevertheless you got a shield, the KG, which granted you personally a limitation of liability against the outside world, because a limited partner is not responsible for the debts of a KG. You know that. So that was the best of all worlds. It's still a very popular legal form in Germany, because that is something which you should never forget. Once, when the public finds out there is something which is attractive to save taxes, they are going to do it, and they are going to do it again and again and again, and even if it later makes no big sense anymore, they will do it out of tradition. For example, there have been countries in Europe or regions in Europe where in 1500 or 1600 there was a kind of luxury tax that was a windows tax. Who could afford such a luxury like a window with glass panes, or who could afford a building which was relatively large, you could then just count an amount of windows, and so you could count if that is a rich person or not. So there were countries where the people afterwards adapted their behavior and tried to avoid as many windows in the building as possible. So, and later the tradition remained even after the abolishment of a windows tax. In these regions, people are rather reluctant to build houses with large and many windows. You inherited that behavior from your parents, grandparents, grandparents, and so on, and so you are not going to change that. People forgot the reason for their behavior, and later what remained was that general attitude: who builds a house with many windows must be an idiot. The same here. It's frequent and popular to found a small enterprise, at least in the legal form of a GmbH and Co. KG. And so very often this is always also a legal form which is under debate. By the way, there are also some additional examples or effects under which a GmbH can have advantages. So there are also some other reasons why it didn't die out. Okay. Good. By the way, a GmbH and Co. KG, if you found such a thing, you will have to do two balance sheets, one for the GmbH because it's an enterprise, and one for the KG because it is a partnership in which the enterprise takes part and the KG also runs the business. Good. This is one of the disadvantages. In the US, you have also a corporation tax system where dividends are taxed at a highly unattractive because very regular level. At least that has been the case until some years ago. I can't give you an oath on that the situation didn't change. But if the dividends, and as long as dividends are or were taxed at a regular income tax level, and corporation tax was taken before, then you have a double taxation effect economically. So people want to avoid dividends. And then if additionally you have an effect that capital gains from selling shares are taxed at a lower rate, then all people want not to get dividends. They want to sell shares. And so the policy of US companies, especially the big ones, is usually that they mostly avoid to pay dividends, but they offer to buy back shares from their shareholders via the stock exchange. So if you need money, you can sell us back the one or other share. And to make that more easy, they very often split their shares into two or more. So that if you now hold, let's say, 2 shares, after the split, these 2 shares have been turned into 4 shares, 4 smaller shares now, so that it's easier if you need money to sell 1 or 2 of these shares in the stock exchange, get a gain from selling shares, which is then taxable at a lower rate. That influences the complete economic behavior of people within a country. So people from the US are rather unfamiliar with getting dividends. They regard it as a pervert behavior. Some days or weeks ago, I spoke with somebody about the effect that IFRS 9, the IFRS standard which regulates the treatment of financial investment, in the original version evidently forgot to regulate how the reception of dividends has to be shown in a balance sheet. All these people sitting around there in Anglo-Saxon countries are evidently not so familiar with the idea that companies could also pay dividends. For them, it was so strange that they seem to have overlooked this in the first version of that IFRS 9, because the paragraph is an A paragraph, so it has a number ending on an A, so it was introduced later into the final text of the law, of that standard. So in the first version, when the first numbering was made, evidently the fact or the thing that dividends could occur was simply overlooked. So you see how enormous the impact and influence of a corporation tax system can be. Good. By the way, from that last example, that a whole country prefers selling shares and generating ways how one can sell shares over receiving dividends just because of their corporation tax system. From this last example, you can see if you want to have neutrality and if you want to avoid distortions in the market, you will need to design the rules for selling shares in a way that they lead to an equivalent net result, which is entirely identical with the net result which you have if you wait and collect dividends in the course of time. Otherwise, you distort the market. Yeah? So that shows you that if you want to design a corporation tax system, you also have to think about the rules how selling shares has to be taxed. If that does not completely fit economically, you will have drastic effects. So if you decide to tax dividends at a full income tax rate, but the sale of shares at a reduced rate, you need not to wonder later that nobody in your market pays out dividends. So that leads to the effect that all the money is locked in the firms until they later go bankrupt. Or and that in such a system people only sell shares, and so on. The money is always accumulated and stays within the firms. If you want to have a financial market where the money can freely flow to the place where it brings the highest yield or rentability, then you need to have corresponding rules, the rules for the gain of for taxing the gain from share sales which lead to a comparable result to the case where you just don't sell and collect dividends. That explains why in a later video we also have to think about that. Okay, enough for today. Thank you for listening to me, and hope you enjoyed the video, or at least you enjoyed that it's over now. Would like to see you again soon and wish you a good rest of the day. Thanks for watching. Till next time.